doing a deal on suboptimal terms is much better than doing no deal at all. In a way, I agree with that. But if you devote a little bit of energy to setting up the terms in your favor, you'll be surprised at how many LPs, as long as their risk-adjusted return is correct, as long as they have a lot to gain from the deal, they don't care if you make money, especially people who trust you if you're doing a family and friends deal. This is a video that ended up with some audio issues halfway through. Briefly, it does not make it so you can't hear the audio, so I decided to post it anyway because this is good stuff. But I'm sorry you have to deal with some fuzzy audio halfway through. I love my podcast. I've been at the Sweaty Startup since 2018. So going on 3 years here in December. I've been at the Nick Huber Show now for 4 months. And I got to say, it's fun. I get a ton out of it. I learn a lot about communication and teaching. I recommend that if you have the energy and time, you should start a podcast. But man, sometimes you just don't want to get in front of the mic. Today was one of those days. Long Thanksgiving week. Got a ton of work to do. We're closing on all kinds of storage buildings. We launched an NFT project. Life is coming quick. We're having fun. And I just didn't want to get in front of the mic. But what you do is you just get in front of it like this and you just talk to it. And eventually, after about 5 minutes, you stop it, you delete that recording, and then you're ready to rock. It happens every time. It works every time. Now, listen, what I'm about to talk about today is a little bit unfair because a good friend of mine made a tweet and he's not here to defend himself. And I disagree with the tweet. I know there's tons of nuance. We'll tease it out here. But Moses Kagan, you know him, at Moses Kagan on Twitter. He made a tweet this morning that said, particularly early in your career, figure out how to say yes to capital. Later, when you have an awesome track record, you can optimize the terms. And in a way, he's right. In a way, if you have somebody who wants to invest in a real estate deal and you have nothing to lose, you do the deal. You worry about the terms later, you do the deal, you're going to learn a ton. It's just like starting a business versus going to business school. You can listen to this podcast all day, or you can go out and do a deal. You'll learn 10 times more going out and doing a deal than you would listening to this podcast. So in a way, he's right. But the main mistake, one of the big mistakes that I see from early GPs, and let me first, I'm going to tease out a little bit of nuance here. This conversation is directed at people who raise $300,000 to $5 million, maybe $50 million a year on separate deals. This is not raised at institutional capital. This is not directed at institutional capital. If you work for a big private equity shop that raises $300, $400, $500 million a year, none of this applies to you. This applies to the person who's trying to raise money for their very first deal. If you have no idea what I'm talking about when I talk about promotes and splits, go back and listen to episode 2, how real estate private equity works. Or just pause and Google. It works every time. So Moses says, particularly early in your career, figure out how to say yes to capital. Later, when you have an awesome track record, you can optimize terms. Now, in a way, that's true. Many, many people take that route. And this stuff is hard. Real estate private equity is hard. Raising money for your first deal, having the courage to do the first deal, knowing that first deal is going to work, it's all really, really hard. My world at the very beginning was the same. Very, very tough to access capital to raise money for a deal. It took me a year from kitchen table to kitchen table to kitchen table to build our first self-storage facility. But what I will say, and this is why I respectfully disagree with Moses' main point here, it is much easier to do one deal with people you trust on good terms for you than it is to try to do 5 deals on crappy terms or even one deal on crappy terms and that's set up in the LP's favor. Starting a general partner business, a GP business, which is what we do to raise money for our self-storage facilities. If it isn't profitable for 3 parties meaning the GP company, the company that actually raises and manages the cash. This is the CFO, the underwriters, the people who send out monthly distributions, the people who do the reporting, the people who are managing the money. That's a GP business. If it's not profitable for the GP business, they're finding the deals, they're doing the deals, everything. If it's not profitable for the LPs and it's not profitable for whoever manages the property, the property management company, those 3 parties all need to make money. And the number one mistake that I see early GPs do is they try to just get the deal done at whatever cost there is. And they sign up for sub-market management fees, meaning they're managing the piece of real estate for sub-market fees or no fees. That's terrible because that business is not profitable. You're not going to be able to hire people. You're going to be cash strapped. Second most important mistake is that they don't set up their GP biz, the actual entity raising the money, for success by charging the right fees, getting the right AUM management fees, getting the right amount of promote, and basically setting that deal up so that they can make some money. So I know where Moses was going. It's not fair that I'm sitting here talking bad about his tweet, because he was saying, yes, just do the deal, right? Doing a deal on suboptimal terms is much better than doing no deal at all. In a way, I agree with that. But if you devote a little bit of energy to setting up the terms in your favor, you'll be surprised at how many LPs, as long as their risk-adjusted return is correct, as long as they have a lot to gain from the deal, they don't care if you make money, especially people who trust you if you're doing a family and friends deal. Now, a couple more things to add here. There's big LPs. There's big LPs that a lot of people go after, and I'm going to tell you a story about how I went after my first one. So we built our first self-storage facility from the ground up. It was a massive success. We built it for $2.4 million. We acquired the property across the street for $500K. We're all in for $2.9 million, and today it's worth $8 million. Well, 3 years ago, it was worth 5 or 4, still worth a lot more than what we built it for. So we went to a friend who was going to help us raise money and go do more developments. We were not acquiring, we were developing real estate. I'm going to talk about the difference between all the different ways you can go with real estate and the risk and the asset classes and so on. But we went to a big family office to try to raise capital. Now, we were going to raise a fund to build 5 development projects. 5 development projects. We're going to go pick out a location for 5 different new developments, and we were going to build them all. We're going to manage the construction. We were going to be the real estate private equity company, and then we were going to manage the asset once it was done, with the goal of selling it and making a lot of money. This was 2017. We probably could have done the deal and made a lot of money, but I'll tell you what, we went in there and we had no leverage. We had 0 leverage for the capital. That was our only stop. We didn't have anybody else who was potentially going to be able to give us capital. So we had no negotiation. We had absolutely none when it came to what kind of promote and what kind of preferred return we were going to offer. So the preferred return made its way up to 12%, and the promote made its way all the way down to 20%. And we split that. We co-GP'd with the family office, meaning the family office wanted half of our GP stake in perpetuity for the entire life of the fund. That was not very much upside. Basically, we owned 10% of the upside of the project, 10% of the upside. So if we make $10 million, $100 million, we would make $90 million. We'd get 10% of that. 9 million sounds like a lot, but when you do that much work and take that much risk, it's not. Somebody else made $90 million. And the preferred return got really high. A preferred return now, it all depends on the risk, but we charge an 8% preferred return. We give an 8% preferred return to our investors now. They want a 12. So the first 12% goes all to the LPs. Everything above that is split 80%, 20%. And of that 20%, we only get 10% of the upside. We ended up running the numbers 100 different ways and deciding that, hey, this is not worth it. We would rather not take the capital and not do the deal than raise money on these terms. So what you see is a lot of new GPs. They want to go buy a self-storage facility. And they think, okay, I just need outside capital. I need it so bad. I need it. They have all the leverage. I need to find a way to get it. And what they'll do is they'll say, okay, no acquisition fee. Okay, no asset management fee, meaning the cash that you raise to manage that cash. No disposition fee, no refinance fee. High preferred return, very, very low promote. All the ways that a GP business makes money, they start to cut back on because they want to just do the deal and get in the game. And it works for many people. And this is hard stuff. So if you have to do it, I understand. But it's all about leverage. You have to understand this entire thing is about leverage. And if you have leverage, if you have access to capital, if you have good deals, and if you have a track record, those 3 things, you can charge more. It's a market, right? You can create your own market for capital. What we do at Bolt Storage is very, very unique. We add a ton of value to self-storage facilities. There's not very many people doing what we do, and we have a lot of access to capital, so we can charge a fair promote for ourselves and get a fair preferred return. Our LPs can still get a good risk-adjusted return, but we do well. Now, a lot of this depends on risk. LPs, limited partners, the people who invest in your deals, they need a good risk-adjusted return. So how risky the deal is a big, big part of it. The development, going and buying and building with a new sponsor a bunch of self-storage facilities, honestly, an 80% share of the upside for the LP was probably worth it for them because that's a risky deal. We didn't know what we were doing. We only had one deal under our belt and so on. And if you're buying stabilized multifamily in a core market, that's fairly low risk. And if you're buying leased up self-storage, full self-storage facilities that are cash flowing on day one, that's fairly low risk. And you can charge. You can get more of the promote. The less risk there is for LPs that they lose all their cash, the less of an IRR, the less of an internal rate of return, the less of an overall deal level return the LPs need to make the investment pencil out for them. If you're going to do a high risk, new investment, venture capital based, deal where it's a long shot to win, you need almost all the upside if you're putting the cash in because you're putting your cash at severe risk. But if you're doing a deal where, okay, let's see what are the odds that this deal goes sour. If you look at one of my deals, we only leveraged in about 53% of loan to cost. So 53% leverage, 47% equity. Low debt, right? Low debt means, okay, lower risk. Lower the debt, lower the risk. And let's see, what are the cash flow returns year one? Maybe 6 to 8%, okay. It's cash flowing on year one. What's the debt yield? Over 10%. If you're not sure what debt yield is, go back to, I think it's episode 4 of the Nick Huber Show where we talk about debt and risk. But how much income, how much net operating income does your debt, all the debt on the project, yield you? That matters when it comes to risk-adjusted return. So would you rather, it all comes down to, would you as a GP, a new GP, would you rather do more deals and own less of each deal? Or would you rather do less deals and earn more of each deal? The answer is clear to me. I would much rather spend the time and do the work to find a good deal that I can charge good fees on and make sure that I charge them or go to different investors, or not do a deal at all. That's where I am right now in my career. I'm all about raising prices, adding a ton of value, getting really good at what you do, and then charging a fair price for what you do. I think you should do that as well. And when you're dealing with people who trust you, friends, family, early on, if you can get them a good risk-adjusted return, they're not as worried about a small acquisition fee. They're not as worried about an asset management fee. They're not as worried about your promote over a certain 15% hurdle. So what I would recommend to you is say, okay, how can we take the risk off the table for the LPs? Maybe an 8 or 10% preferred return, meaning I don't get paid anything unless they get 8 or 10% of their money. And then beyond that, let's say, okay, you get 75% over that 10% preferred return up to a 15% return. So until you get a 15% return on your money, you're going to get 75 or 80% of the upside. But after that, if the deal goes really well, over a 15% IRR, guess what? I want half as the GP because I've made you a lot of money at this point. It's time for me to get paid. I want half. Another really important thing to talk about is the difference between a fund and a deal-by-deal structure. Now, there's good things about a fund. The good thing about a fund is that you have cash there. You get to decide what deal you're going to do. You can close quickly. You can close all cash. And the LPs have very little say in what you do with that cash. You can go and you can buy a deal quickly. You can use your best judgment. You can close deals. A deal by deal means I'm going to go look at this storage facility in North Georgia, and I'm going to say, this is our deal. I'm going to lay it out. I'm going to show you the projections, and we're going to do this deal together, and you can tell me whether or not you want in this deal. I always recommend deal by deal. A fund is great for deploying tons of capital. It's really hard to deploy tons of capital in this market right now. And a fund also makes it really hard to get in your promote, because remember, your promote, you're the last one to get paid. You, the GP, you are the very last one to get paid in a real estate deal. Everybody gets their preferred return. Then you got hurdles to clear. You got to return all the capital. And if you've done 5 or 6 acquisitions, let's say there's 5 buildings in one fund, and you sell the first one for a big profit, you're not getting paid yet because the preferred return is still acquiring on all 5 buildings. You haven't returned all the capital. You haven't hit the hurdles, and you're not getting paid. You might sell number 2, still not return all the capital, still not hit all the hurdles, and still not get paid. You got to sell all the deals, and you're the one who gets paid last. So what you have with a fund sometimes, you have to wind down the whole fund, and you don't get paid for 2, 3, 4, 5 years, and you got to close that very last deal. And that very last deal means it's all yours. That can be great. People make a lot of money that way, but I prefer to do it deal by deal. Meaning if I close out one deal, it's a really good deal for you, I'm in my promote right then. I'm in my promote right then. I'm getting paid right then. I can reinvest my money. I can take it. I can do whatever I want with it. It's a really important part. Now, one more thing. So after Moses' early tweet, we have this one here by Derek Carroll, great guy on Retweet. I don't know anything about his experience level, so it's really hard for me to also pick on him. You see the number one mistake that I think a lot of early LPs make. He says, yes, I understand. I have to treat my personal deals the way you're talking about, the way you and Moses are talking about. I think I had said something like, this is all aimed at, $2 million deals, not $200 million deals, because I think Derek works for a big fund and also does deals on the side. He says, for me, it is first about getting the deals done, and second, about earning income to support the business. That is such a wrong way. That is such a bad way to think about doing your own personal deals. If you're just thinking about doing deals, getting the deal done, without worrying about how all three branches are going to be profitable, the LP, the GP, and the property management, if your GP stake and property management are not profitable, then you cannot, responsibly do a deal. You can't. Because guess what? The last 10 years have been phenomenal. Every investor that's done a deal, even on shitty terms, they've been able to exit, they've been able to sell, they've been able to get out of the deals. But guess what? If things turn around at any time, and we talk to our LPs about this all the time, at any time the market could shift. Interest rates could go up. We could be in trouble. And it could take 5 years or 10 years of holding on to this asset. It could take 5 or 10 years of holding on to an asset until we finally get out of it and can sell it and can get liquidity for it or get profit for it. So what are you going to do if you're running a property management company, self-storage management, whatever, and a GP firm, and there's not enough income coming in to support the business? How are you going to feed your kids? How are you going to send them to private school? How are you going to make your house payment? How are you going to keep your staff on without doing more deals? So many sponsors get in this trap of, let's do a deal. Let's not worry about how much is in it for us. Let's not worry about fee income. Let's not worry about the sustainability of this from our perspective. Let's worry about getting the deal done. Let's get the capital. Get the capital in the deal. Let's do the deal. And then tough times hit. Tough times hit and you're stuck in the deal for a long time. Something happens. 3 years, 5 years, you got to hold on to the deal and you got to operate it. You're stuck doing a bunch of work for free. It's terrible. That is a terrible way to live, and it's actually how you can get insanely cash strapped and not have the cash needed to hire good talent. You start skimping, the properties start getting neglected, and you end up losing everything. So what I'm going to do is I'm going to recommend to you, even on your very first deal, charge an acquisition fee. On a small deal, 1%, 2%, 3% of the purchase price. Charge that acquisition fee. Charge an asset under management fee of 1%. If you're not doing property management as well, maybe 0.5% or 1%. If you're not doing property management, somebody else is, or it's just leasing or it's a triple net lease, maybe you charge a little more. Maybe it's 2% asset under management fee. Then you need to charge a disposition fee because to sell a property takes a lot of work. Maybe it's 1%. You got to sell a refinance fee because refinancing a property takes a lot of work. Anything that requires work for you needs to have a fee charged back to the entity to do the work. It's that simple. Listen to Chris Powers on this. I'm going to Google this right now because it's really important. Chris Powers has a podcast episode on fees. And it's episode 180. November 9th, 2021 of The Fort with Chris Powers. The Fort with Chris Powers, episode 180 on November 9th. It says, GP fees and the pathway to building a world-class real estate private equity company. He's talking about how these fees that you put into your deals actually help you and your LPs because you can build a sustainable business, a profitable business that can then grow and scale and do a very good job. You can attract good talent, you can afford good talent, and you can do a good job with everything that you do. So Chris has an hour and 10-minute episode on the difference between no fees, what fees you should charge, the misconceptions around charging fees, and why making a profit for a GP company is bad in the eyes of a lot of capital holders. And listen, somebody also said on Twitter, pull up the screenshot here. Somebody said, most institutional investors actually prefer that a sponsor is motivated and want to give them favorable terms. If interests are aligned, then all parties are working for the same goal. Can't demotivate the GP. And then he goes on to say that front-loading fees disaligns incentives. That having fees early in the deal, meaning an acquisition fee, maybe you're into the cash flow before the investors get their capital back. And what he's doing is he's regurgitating things that he hears from capital partners, because when you're in a room with an LP, maybe a big family office that deploys a ton of capital, it is a negotiation for every last dollar. You are doing a business deal. I mean, yes, you're rowing the ship the same way. Yes, you can have a great relationship. Yes, you're making each other money. And yes, you need each other. And it's a win-win relationship. But many of them, rightfully so, know how to fight for every last dollar. So what they do is they negotiate, they beat you up on the promote. They negotiate, they beat you up on the fees. They negotiate, they beat you up on the preferred return. They're doing what they can do to get the most of a deal that they possibly can. Why would they not? Why would you not? So that is not always true. Some investors do prefer that the sponsors are motivated. Absolutely, they want to have them a cut. But what they'll do is they'll try to wring you dry on all the fees. Whereas you need the fees. You need the fees to live. You need the fees to survive. So what I'm going to tell you is you do need fees at the beginning, because doing a good deal is expensive. Doing a good real estate deal is very expensive. Finding it is very expensive. Executing it is very expensive. You got to put escrow money down. You got to have lawyers. You got to have staff. I mean, my overhead at my company is over $1 million a year. And it's just a machine to build and find deals and buy deals and manage deals. So if you think that a family office doesn't want to beat you up on fees, you're wrong. And if you think that you don't need to charge fees to have a good investment structure, you're also wrong. So we can agree to disagree. It's all about leverage. It's all about capital. There's a market for capital out there. You can provide investors with great returns while also making money in this business. And your priority in this business is your LPs are your customers, and you need to be servicing them at a profit. So I'll leave it right there. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to the Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group, to get some momentum, get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.